Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and it is again my pleasure to talk to Daniel Lacalle. Daniel has talked to me before, and I've talked to him before, but I will tell you, he is one of the most interesting people worldwide that you'll ever talk to. And I don't think Daniel could be topped by anyone as far as what he's done in terms of talking all around the world. In addition to all the other things you've done, which is a very, very long list, you have 4 great books that are very interesting. I would encourage everyone to read those as well.
Thank you so much. It's my same opinion here. Really always very, very interesting to speak with you. Always get quite a lot of very insightful information from having a chat with you. So a true pleasure.
You know, I'm going to start out with this, and I'll be curious as your opinion. You know, you will see a slide here where everybody is expecting, all of these rate increases for 2022. And for us, it doesn't seem like they can ever get there. But I'm curious about how you feel about that, Daniel.
I would agree with you. I think it makes absolutely no sense to bet on one thing and the opposite, which is what I think that a lot of market participants are doing. On the one hand, you have clearly a bet in the market of a slowdown in the economy, which I think is pretty evident both in the United States and globally, while at the same time betting on 7 rate hikes. I don't think so. I think it's very, very difficult because we know that the Fed obviously does deliver on the first couple of rate hikes. That is not a problem. But I find it very, very difficult to believe that once the data starts to accumulate the slowdown elements that we can see both in the labor market and in consumption, credit growth, etc. It is very difficult to believe that the Fed will implement 12 rate hikes, let alone the ECB with what the market expects, which is about 5 rate hikes, almost impossible in considering the situation of the euro area.
You know, too, Daniel, just in a brief slide here, if you look at government debt at 30 trillion and total debt in the U.S. at 90 trillion, it's hard to see. I think people forget how hard it is to raise rates when you're that leveraged. What do you think about that?
Completely. And think about it from the perspective of developed economies that not only have accumulated enormous levels of debt, but they're also adding debt every year through deficit spending. It's virtually impossible to think that you're going to have real rates back to normalized levels when the US administration has presented a budget in which they, with their assumptions, expect that in a decade, the deficit will reduce to $1 trillion a year. That's enormous levels of not only accumulated debt, but accumulating debt. And obviously, that is on the government side. If we look at the private sector, we also tend to forget that the corporate sector is significantly less leveraged than the public sector, but there's still a tremendous amount of debt also in households and in businesses. But if you look, for example, at the euro area, the big problem is that there is no single Eurozone sovereign issuer that is currently even close to issuing debt at the levels at which we would consider normal for the solvency and the liquidity of the issuer. Now, think about it. If the ECB delivers on the rate hikes and at the same time bond yields continue to creep up, as they have, we can have another debt crisis like the one that happened in 2011.
And let me ask you, you've mentioned this numerous times about how we could be looking like the 1945 to 1954, 40s and the early 50s. And I had a graph there that showed that where obviously the prices, consumer prices were going up a lot faster, than the interest rates were. You still think that is maybe a possibility?
It is a possibility. There are differences, significant differences. The level of debt is massively higher than in the 40s. There is also no slack in the economy. In the 40s, there was quite a bit of slack that allowed the manufacturing sector to grow at least in a double-digit way. But putting aside those differences, it is true that we can have a situation in which at least core CPI inflationary pressures remain elevated, and at the same time, the level of growth is significantly more subdued than what we have been assuming for a recovery period after the COVID crisis. So I think that there are quite a few elements that we could consider as similar, and more actually to the 40s than to the 70s type of stagnation.
Daniel, there's an old commodity line that says that high prices cure high prices. And it looks like to us that that's sort of what you're starting to see now in oil and some of the other commodities. How do you feel about that?
Absolutely. Absolutely. The idea that demand is inelastic and will continue to rise no matter what the price is, it never happens, no? And there are two things that happen. First is demand destruction. We're in natural gas. It is pretty evident, for example, in the European Union and in Asia, where you see quite a significant reduction in the estimates of demand growth. And also in terms of the new supply that is coming in. But what is concerning, at least from the perspective of commodities, is that the inventory levels right now are extremely low. So what happens is that, yes, maybe high prices lead to demand destruction and to a reduction in the marginal price, but the floor to many of the commodities, particularly energy commodities, is probably significantly higher than what people would consider as acceptable because of the very low level of inventories and obviously the geopolitical concerns and the problems that are happening with Ukraine.
Yeah, Daniel, let me ask this question. I think we're up to around $11 or $12 per liter where you are in terms of gasoline. Is that having an impact on consumption in Europe?
Huge. It is huge. The equivalent to $11 a gallon, which is the price in many of the European countries, well, in others, it is significantly higher, is having a very significant impact. We see, for example, that a very modest reduction of prices with a subsidy in some of the European countries created a massive scene of queues outside of gas stations that we had not seen since the 70s. So it is affecting the transport sector massively. Most of the trade between the Eurozone economies is conducted via trucks. And that obviously is seeing very high prices for the cost of transport, but also for households. And you see it, for example, now we are in a period that is holiday, and the number of vehicles that you see on the streets and on the roads going to holiday destinations is significantly lower than you would imagine in a period like this.
And Daniel, let me ask you something. Here we're starting to see, just in the last month, for example, we've seen real estate deals that backed off, couldn't get closed. We've seen companies that were going to be bought that now are not going to be bought. On the leverage side, all of a sudden their rate structure is up 25 or 30%, and they're having to back off the deals. It seems as though that the stock markets are all in denial of that. Do you see that the case, or do you think it's business as usual with the markets?
I think that markets are ignoring completely signals that are very evident in the credit market, and things like the ones that you've just mentioned are very important. The stock market is fixated on the view that even with the rate hikes that have been announced, we will still have negative real rates, that the policy of central banks will continue to be accommodative, and that repurchases will be elevated in any case. But the equity market is forgetting the macroeconomic slowdown, the challenges to margins and to profits of most of the corporates that are quoted, and the very significant impact of the credit crunch that is already happening in the riskiest side of the credit structure. There is this sort of complacency out there in which what you see is numerous market participants talking things that we have heard before, like, well, this is only 1% of the total credit market. Well, this is affecting only 2% of the total assets of the banking system. Well, we all remember that analysis with the housing bubble and with the credit crisis in the European Union. No, we have to be a lot more concerned about the reality of those signals that are more and more evident and more frequent, as you just mentioned, and that the market seems to be ignoring.
And you know, if you see this slide about the fixed mortgage rate now, and this was yesterday, it's at 5.06, which is a new recent high. And you have to believe, or I would think, if I'm asking a question of you, would you think that that has to have some sort of impact in terms of slowing in the housing market?
Of course it does. But you know what happens is that a lot of people in the market and a lot of economists don't pay attention to figures like this one. And they tend to forget that that mortgages in the United States are not the same as mortgages in the European Union or in Japan, where they're basically significantly cheaper. And also because they're not really mortgages, they are private loans backed by all of your belongings. So that's why they're cheaper, and they tend to provide credit for longer periods. No, but and this is very important. Why? It's important because it has been also the driver of the improvement in the economy. Is that we forget sometimes that the housing market has been an integral part of the recovery and can be the integral part of the slowdown. So at these rates, it is virtually impossible for a household that is on the one hand suffering from elevated inflation, at the same time real wages are not growing, to get a mortgage or to find the possibility of selling a property that is in the middle part of the pricing structure, isn't it?
And you know, speaking about slows and slowing downs and that kind of thing, I wanted to mention there's two things I was going to show here. One was you'll see a graph on the price of oil, which obviously was up around 125 down to around 93, 94. And obviously it's backing off some. And what we're starting to see is, at least we're seeing this, is a bit of disinflation, not necessarily deflation, but disinflation. Are you starting to notice that in a lot of categories?
There is. You see it, for example, in the cost of freights. There is disinflationary pressures coming from the destruction of demand created by prices that went up too much too fast. So I think that there is quite a bit of that in the most cyclical part of the economy. obviously, also in the parts of the economy that are more exposed to China, because the slowdown in China is quite significant. So that is, I think, quite evident. But what I find interesting at the same time is that the floor that has been created for many of these prices remains stubbornly high for what we would consider, the normal or at least the acceptable prices of many of these goods and services.
And the slide on the food index that I'm showing, which is at an all-time high, and I think you have to take food by itself, just because of what's going on in Ukraine and different things. I don't think the public's aware of what Ukraine actually produces in terms of agricultural that affect us. But how do you see that playing out eventually? Because we're obviously peaking in this food price index, and that in itself will have some impact on the demand for food.
Sure. I think that the first thing that we need to understand is that we need to go back a few years ago, before the COVID crisis. And we should not forget that in 2018 and 2017, there were protests all over the world, from Chile to France, Germany, to countries in Africa, etc., because of the rising cost of living, driven fundamentally by elevated food prices. Food prices are the first thing that can cause a significant increase in the level of discontent of the population in countries in which the level of poverty is significantly higher than what the United States has. So the first thing that we need to be aware of is the rising discontent. And that is something that even in the French elections, you had shown quite evidently. The other thing that I would say is that unfortunately, the Ukraine and Russia impact on food prices is so huge because of the percentage of exports that both countries separately and together mean, that added to the fact that because of the Ukraine invasion, there will not be harvesting season like the one that the market would require, is that there is likely to be some level of disinflation short term, but again, not enough to bring food prices to a level that does not trigger discontent in the poorer countries.
It's interesting, Daniel, because people don't realize that just because a price doesn't go up as much this year as it did last year, doesn't mean it goes down. It stays up.
Exactly. It's difficult to say when people say inflation is coming down. I know you don't even imagine the number of times that I've had to say on television, you have to remember that inflation is accumulative, and that inflation is coming down doesn't mean that prices are coming down. It means that prices are rising at a slower pace. It's a different thing. So But I'm extremely worried about this situation with food prices, because in many of these economies that cannot accept a 30-40% increase in so many of the essential goods and services, what we don't have is any sort of credit cushion. So I'm worried about Latin American economies, and I'm worried about African economies because of this.
One of the things I was going to ask you too, relative to Europe, because obviously I'm not certain people in the U.S. realize how weak Europe is, right now. They don't know. Do you agree with that?
Well, what happens in the United States is that there's this sort of rosy picture of the European Union as that has absolutely nothing to do with reality. Now, any U.S. citizen would be absolutely shocked at at what is now the allegedly record level of employment that the European Union has. No, we're talking about 6% unemployment in the United States. That is untenable, no, unacceptable. But also, I think that what people don't understand is that the massive level of government spending generates a very weak level of growth and generates much poorer recoveries and much slower job market recoveries. It's interesting how, for example, in the United States, I hear constantly the debate about wages. No, wages are going up 4%, but inflation is up 8%, 8.5%. Therefore, wages are not rising as they should. You should look at the European Union. In the European Union, inflation is 7%, and wages are growing. Nominal wages are not growing at all. So you have to understand that the situation in Europe in general is much closer to a recession. The impact of the Ukraine crisis is enormous on the European Union. Just to give you a very rough idea, for every dollar of sanctions that are implemented on Russia, about 20 cents backfire on the European Union. So it's a very, very important impact. And all of this comes after a very weak recovery. So we forget that the second part of 2020 and 2021 were very poor recovery years in the European Union. Therefore, the slowdown is much more aggressive on the average citizen.
And you know, we have a graph here of the European-focused fund flows, and obviously, the last 2 months, they've really been coming out of that market, and it's shown up in the pricing. But it looks as though if you take China and Europe, obviously doing very poorly in the marketplace, and then again, the U.S. just sort of in a state of denial that everything's okay, we're an island, and everything's great with us, no problem. And it seems like eventually that has to change, I would think.
It will. I think it will. It is one thing is absolutely true, is that the ripple effects of the Ukraine war or the intervention and the COVID, or I don't know how you want to call what is happening in China right now, the impact on the United States is significantly smaller than in the European Union or in Latin American economies. However, that doesn't mean that there will not be an impact, and the impact is coming. It's showing first in inflationary pressures, but afterwards it shows that in the combination of the weakening effect of the stimulus packages with the global slowdown, and I think that obviously is going to hit probably the United States in the fourth quarter of 2022. Whilst we are already in the middle of that impact in countries like Germany or obviously China and in many of the European economies, absolutely.
And you know, Daniel, on the market, as the way the market sees that, it looks as though, at least to us, that we could be in for a classic type of bear market where, you know, you roll over from a high and you have these what we call crackback rallies, and sort of, in fact, we have a graph of that. But you can have a lot of rallies moving contra, but in the big sense, in other words, the trend is lower. Does it feel like that to you, or do you think we're just in a holding pattern?
I think it's pretty evident. I think that when you see a big rally, volumes are significantly lower than the extent of the rally is fast but short, and then the correction is aggressive and with higher volumes. And those things tend to be the keys of a bear market rally. No, I think that coming back to what we were saying before, if you look at other indices that are not the US indices, the trend is very clear. The trend is very clear. And what we're starting to see, for example, in the DAX in Germany, is capitulation. We have not seen capitulation in many of the stock markets definitely not in the United States indices. But in Germany today, we have seen a very significant sell-off in those that were supposed to be defensive stocks. No.
Interesting. I want to switch topics with you that really sort of goes back to your one of your books, your latest book, really, Freedom or Equality, which I think your views on the intervention and how government has damaged the middle class. If you just take the central banks and the governments in terms of fiscal policies and the deficits they've run. And it's interesting because I think in the U.S. it's gotten worse and worse and worse. But I think that's where it feels like that's where we are today, that people don't realize that they're ruining the system. And that's why I'd recommend everybody read your book, Freedom or Equality. But that's just one of your 4 great books. But you see that changing at all? To us, it seems like it may be getting worse. But I'm curious at how you see that now.
It is getting worse. It is getting worse because in the United States, it has become a mainstream economic view that deficits don't matter and that elevated levels of debt are irrelevant, and that what the government has to do is just spend and forget about the consequences. More importantly, there is what I don't see any analysis of the real economic return of stimulus packages. But what I do see is that those stimulus packages are implemented and the placebo effect lasts less and has a lower impact. So everybody has sort of grown accustomed to the idea that if it's not in a trillion figure, it will not have an impact on the economy. And that shows that it does have an impact on the economy, slowing it down. And I come back to the point of the European Union. If you copy the European Union policies, you get European Union unemployment rates and European Union growth rates. And and there's this view that is going to be different in the United States. It is not, because the more entitlement programs that are implemented, the higher levels of government spending, and with it, higher levels of taxation, the reality is that what you're constantly seeing is a transfer of wealth from the savers, from businesses, from people who are making a wage to the spenders, to the government and to debt. And that obviously always ends up in a very significant slowdown, and if not, in a very significant crisis. So either of the options is not a positive. The potential of growth of the economy is significantly higher than what we have been used to hear that is the norm. And the reason why we hear that it's the norm is because economists rapidly sort of change their views to adapt to a slower growth and to a slower level of employment and wage growth, which is not normal. And it comes from a very simple factor. Anyone that has a business can understand that you may have a division that is not performing adequately, or a division that is even loss-making. What you don't do is use all of the resources of the profit-making divisions to bloat the underperforming or the loss-making division. Well, that is exactly what we're currently seeing in terms of budgeting and in terms of government action in the economy. A complete lack of analysis of what was the impact, what went well and what went wrong about massive trillion-dollar stimulus packages, and at the same time, a sort of easy recognition that the slowdown has sort of nothing to do with all of that, and is simply some external factor and not the consequence of that elevated deficit spending.
And Daniel, it looks as though, what we've been doing here for a number of years is giving the middle to lower class, sort of a hit, like it's dope to make you feel good, but it's only for a short period of time, and then it goes away. And I think one of the things in in your last book that I thought was really interesting, I'd like for you to talk a little bit about it, is that how, and we felt like this for a long time, we've been ruining the middle class. And it comes from government and central banks, and people, I'm not certain people realize that, but we're blowing up the very fiber core of really what made this country so great.
Absolutely. The disappearance of the middle class is not a coincidence, it's a policy. And it comes from constantly debasing the purchasing power of the currency and increasing taxation that erodes the ability of the middle class, first to save, second to progress and move up the ladder. So the idea that government is going to spend trillions and that will only be paid by the 1% and that everybody else is going to benefit is such a fallacy. It's so simple to explain as well, is that you don't collect trillions of dollars from the economy from 1% of the population. You collect it from 90% of the population. And that collection comes from inflation, from loss of purchasing power of the currency, and from the destruction of the ability to save and improve and move in the ladder. And obviously, what some economists say is that it's a quid pro quo, is that it's a social use of currency to benefit the majority, but it is not, because it ends up massively and disproportionately benefiting the first recipients of money. Money creation is never neutral. It's ridiculous to think that money creation is neutral. Disproportionately benefits the first recipients of money, government, and the hugely indebted, and disproportionately negatively affects real wages and savers. So the middle class is basically just being eroded from those sides, from those two sides. And that is very negative, because no society progresses based on spending and debt. A society progresses on saving and prudent investment. So if you, through very low rates and high liquidity, in a certain way end up subsidizing malinvestment and overspending, what you're basically doing is actually negating and putting brakes on the very fabric of progress in the society. And that's what I find funny about this, is that the people that defend those policies call themselves progressives. That's not progressive, that is regressive, because it ends up destroying the possibility of somebody through that is going to be able to go to the level of being one of the wealthy people from hard work and saving, and makes it much more difficult. That's why it's so negative. It's profoundly regressive.
So Dan, let me ask you, sort of in wrapping up here, I'm just curious, how do you see all of this? What do you think is going to happen over the next 5 to 10 years with everything the way we are and the way we're going? I mean, do you see any way out where we get back to some sort of normalization that where we would have been maybe 25 years ago? Or do you think that's past now? We're past that point?
No, I'm an optimist, and I believe that things happen in waves. And we are back to the wave that I lived in the 70s, in which people think that the only solution to bad interventionism is more interventionism, in which people perceive that government is going to do everything for you. But the reason why I'm an optimist is because it's become very evident in numerous elections from the UK, even France, even so many other countries, that people don't believe that anymore, and that there is a rising percentage of the population that perceives that it is not, the solution doesn't lie on the government hands. Governments have to facilitate, not to, they're not going to be Santa Claus for anything. So I think that perception is changing. Some places it's not. In some countries, it's very far away. In other countries, it's closer. But I'm an optimist. I think that the same thing, the same way that in the 70s, it looked almost impossible to believe that something like what happened in the early 80s in the United States, in the UK, in the European countries would happen. I think that it will eventually happen as well.
Well, I appreciate that upbeat feeling on the way out here. I do want to mention to everybody that we've shown a couple of times your name and Tressa's along the banner at the bottom. I would also encourage everybody to look at your books. I think you've written some of the most interesting books, and you have an incredible resume of everything you've done really in the last 20 years. But I want to thank you, Daniel, for being with us today, and I really, I hope maybe we can have you back here before the next year to see how all this plays out. I'd sort of love to have you back.
Oh, it'll be an absolute pleasure. I really enjoyed it. So thank you very much. Thank you.
All right. Thanks a lot then, Daniel.
Have a good one.